Welcome back onto our coverage of the UBS conference as well. We are now being joined by Vishal Goyal, the head of research, and Tanvee Gupta Jain, the chief India economist at UBS Securities. Vishal, Tanvee, good morning. Thank you so much for joining in. I'd like to start off with asking you, Vishal, the market correction that we are in currently. The broader markets and the Nifty currently are almost down a similar quantum from their respective peaks, right, around 10% each. But when the large cap index corrects to that an extent, you would assume that the mid cap index would or broader markets would see a much sharper fall. For a better part of the last month, the mid-cap index were fairly resilient, and only now they are facing that selling pressure. What would you attribute that to, one? And do you see a much sharper correction in the broader markets now so that it can play a catch-up with the fall that you've seen in the benchmark index?
Hi, Omar. I think that expertise is anyways with Sunil Tirumalai, who is our India strategist. But I think I'll share my views here. I guess, Sunil has been highlighting that Indian market is expensive, especially in the context of emerging markets. And as we see things, at global geopolitical stage, plus global volatility has increased, I think that also brings again focus back on valuations for India. In terms of key sectors, if you look at, there are sectors who are, at life high or 5-year high valuations, and there are sectors which are trading below averages. And so to that extent, I think that dispersion in performance, I think would continue. We would see some catch up in sectors where the valuations are more reasonable compared to segments where valuations are rich, and we are seeing some earnings disappointments coming through.
Okay, all right. So the earnings disappointment is something that the street doesn't seem to like. Let's get in Tanvee in the conversation as well. Tanvee, the big data that we got yesterday, the CPI figure above that 6% mark. Was it something which was penciled in by the street already? What surprised you this time? And what does it mean for the RBI action going forward? Because that's everything that somebody wants to know now.
Absolutely. So if you look at the CPI inflation, number was 6.2. We were expecting 5.9. So definitely even higher than our consensus expectation. But if I look at the data, I realize bulk of it was only on account of higher vegetable prices and gold. If you look at the cyclical food price component, it almost accounts for the bulk of the increase in CPI headline inflation, which is more transitory in nature. So I would expect the vegetable prices to start softening from the month of November. But very interesting, I tried to look at the retail data for the month of November for key vegetable crops, at least what is available in terms of retail prices. While I could see a very sharp correction in the prices of tomatoes, which is almost down 25% month to date, I could see that the prices of onions and potatoes are still elevated. So what we are seeing this time around is a much higher trend in vegetable prices. I mean, last 10 years, month-on-month momentum in the month of October used to be 4%. This time it is more than 8%. But I would say this is mostly transitory in nature. If I look at how my forecast for CPI inflation will pan out, because that will have implications on RBI's policy outlook, we are estimating CPI inflation to soften towards 4.5% and 5% in the rest of FY25. From a rate cut expectation, I think RBI is facing a very challenging task. We are seeing growth softening concerns, even though RBI is still maintaining 7.2% real GDP growth forecast as of its last policy. Inflation risks have come up, but that looks like more cyclical in nature. At the same time, the currency has weakened because of a stronger USD. So I would say net-net, we are still retaining our baseline forecast that there are 75 basis point rate cut expectation likely from early 2025. I think the timing will be a lot more data dependent, and we definitely have to see that the inflation momentum is more towards 4.5% going forward.
Would it be fair to assume, Tanvee, that a February rate cut is off the table?
I would say a December rate cut is clearly off the table. I would not really say that Feb rate cut is off the table. Because cyclical component, as I was mentioning, they go up very fast, they actually come down also equally fast. So I would hope that the fresh crop arrival, once it starts hitting the market from the last week of November, should start cool off the prices from the month of December onwards more meaningfully, which may not be visible so much in the month of November. So I will still have a higher probability of a rate cut cycle to start from Feb. But let's wait. We'll watch out for more data.
Okay, all right. So Vishal, coming on this, what does it mean for the banking space? Of course, December rate cut is ruled out. We'll have to see how RBI goes ahead with any rate cuts, only basis data that we have been getting, the macro data. How are you looking at the entire banking space, quarter two? What stood out for you in terms of numbers?
Sure. I think, see, on banking, we've been having a neutral kind of a view, partly because of the growth slowdown. This was largely driven by unsecured lending slowing down, plus also the constraint on deposit growth. The deposit growth has not been great, and banks trying to bring down LDR was also bringing down overall loan growth. So that was on the growth side. In terms of outlook for margins, the longer RBI takes to cut rates, I think it is good from a margin point of view in the very near term. So maybe we don't need to cut margins as much because if the rate cuts get delayed, banks don't necessarily pass through their EBLR rate cuts. But I think the third pillar, which is asset quality, and that's where I think again we've been highlighting the pressure point building up since last 1 year. There are views on asset quality that things could be peaking here, which we don't agree with. We think the retail NPL cycle, especially the unsecured one, it has just begun. We would see credit costs going up even from here, and to that extent, I think consensus will have to cut earnings for banks in general, and especially for weaker banks and NBFC segment.
So what about the overall earnings picture, Vishal? Because the quarter, if you can stick your neck out and say, was rather disappointing compared to estimates. Even the first quarter was equally muted. What does that do to the second half and the full year estimates as well when it comes to earnings and as a result the market? Because a bigger factor for the market correction has also been these disappointing earnings.
Yeah, that's true. That's true. So I think that has triggered, some of this rich valuation to come off. And I'm not talking about banking. I think in banks, while the valuations have been reasonable, it's just that the top line growth has been decelerating. Plus the asset quality pressure started building up, which kind of capped the re-rating which you could have seen in the banking sector overall. And when we think about earnings cut, you're right. I think for financials, I can see that banks will not re-rate from here, and therefore we should stick to banks who have higher compounding, higher ROEs. NBFCs, where the risks of unsecured credit is high, we would avoid those because we would see a de-rating, especially driven by more earnings cut in that segment.
Okay. All right, take that point, Vishal and Tanvee. Thank you so much for joining in today and giving us your insights, especially after that big CPI number and what's happening in the markets recently as well. Good to get your expertise on the fundamentals of the markets as well. Well, it's time for a short break. On the other side, we'll be joined by the management of BLS International to discuss the company's performance in the quarter gone by. Stay tuned.